the chapter we're going to be looking at. First thing is we're going to look into FAPS unit. What is FAPS is all about? This is called Financial Accounting, Preparing Financial Statements. Here we're going to learn about sole traders and partnership mostly. You will hear something about financial statements for the companies, but we will not do that in detail until you go to level 4. So level 3 is solely for your sole traders and partnership accounts. Here we have an assessment at the end of the study period. Wherever you're going to do the assessment, this assessment is going to be computer based. You have 6 independent compulsory tasks. You must do all those 6 questions, and it's for 2.5 hours. The 6 questions are split into 2 categories. The first 3 questions are based on something called advanced bookkeeping from the previous accounting qualification. There you're going to learn about all the adjustments, the end of year, adjustment you do, the irregular transactions, errors, suspense accounts, so and so. Most of the things like accruals, prepayments, depreciation, disposal of non-current assets, adjustment at the year end, those things will go in there. And the last 3 will be something to do with FAPR unit, which used to be in our old accounting qualification. They combine them together to bring this one gargantuan unit here, which accounts for 40% of your overall outcome for the level 3 qualification. So if you do well on this, you have a really good chance of obtaining a distinction overall from your level 3 qualification. So that should be your bar. You need to keep your standards high, and you can always target to get a higher and higher, and gives you more confidence as well. It is just a number and it's just a letter there, but that confidence, what it's going to give you, it's going to take you further and further towards in your accounting journey towards your goal. And here what we have, what we'll be covering today, it's understanding accounting principles, underlying accounting preparations, understand the principle of double entry, and then of course the advanced double entry, and then implement procedures for the acquisition and disposal of non-current asset. We're going to talk about those as well. We're also going to talk about a little bit of a depreciation as well. So first thing we're going to do is accounting for VAT and payroll. I'm not going to do double entry for you because you already went past that test in level 2. You have done plenty of double entry there. You've done your debits, you've done your credits, you've done your debt click, you've done your Alice, you have done your VAT control account, you have done so many things. You also may have done the payroll account, but it's just a quick refresher of what we're going to be doing here. So we're going to do in this unit, we're going to talk about VAT. We're going to look at elements of payroll and accounting for payroll and accounting for payroll transactions. So these are things we're going to be giving you an exposure of it at the moment. So let's have a look into what is VATs. VAT is something charged on taxable supply of goods. You're going to learn about that in depth when it comes to the tax process for business unit, which is the most likely to be your final unit of your level 3 qualification. If you're doing only the bookkeeping qualification, you do FAPS and TPFP. So therefore, it's a good thing to keep an eye out for this VAT as well. It's going to give you a really good foundation before you go to your TPFP unit. This VAT is charged by HMRC for goods and services, and that taxable person in the course, the business will collect from them and pay that on behalf of you to HMRC. So therefore, it is an indirect tax. It does not cost the business. The business does not pay VAT if I'm the one, I'm going to buying and selling it. I collect my VAT from my customers and pay whatever VAT the supplier. Any difference, I settle with HMRC. Therefore, it is indirect. It does not have any direct impact of my standings. Normally, the end customer, the ultimate consumer, they're the one who's going to be bearing that one. So here, example of a VAT control account. You probably have seen it plenty of time. So if I have sales anything with credit or cash sales, the VAT from that transactions get recorded on the credit side of the VAT control account. That means that VAT is my output tax. That output tax is owed to HMRC. So that means it's charged on your income. If that is going to be charged on your income, the VAT we pay towards our purchases, whether it's going to be credit or cash, this is what we call an input tax. What is that input tax going to do to you? That is going to be reducing your VAT liability to HMRC if your sales is higher than your purchase. At the beginning of the business, when the business at its infancy, most likely you're going to be getting a VAT refund. Why? The purchases may be exceeding your sales because you haven't established your business yet. So you probably end up buying a lot of stock, but you're not selling as much as you like. So on that time, you will get a relief on your VAT by having a VAT refund. So as if you look at that here, if your sales is on the credit side, sales return also going to be on the opposite side. Why? When you return the goods, the customer sending the goods back to you, you have to pay them back. So therefore, the VAT we collected, we also going to pay it back to them. So therefore, the VAT for that can be claimed back from HMRC. So there is many ways we're looking into that, but those are level 2 stuff. But you need to know them to progress in level 3 as well. So if you think you've forgotten about what you learned on your level 2, this is a great opportunity for you to go back and check, revise, refresh, and come back and join the fray here. This part, we're going to look at it. It is going to be more and more advanced section of your double entry bookkeeping. So here we have accounting for credit sales. On the credit sales, what we're going to do, we're going to debit our receivables account, credit VAT, credit sales. Can anyone tell me where these transactions were originally recorded in? If I remember it right, they were in one of our books of prime entry. What we call that? Sales daybook. So this sales daybook has a gross column, VAT column, and a net column. So these two goes into the credit side, and this one will be on the debit side. Of course, it's understandable. So what we're creating here is a receivable. This is an asset account. I'm going to have the receivable account as my asset because it is something the customer going to owe you money and you expect them to be paying them at the end of their credit period. Of course, sometimes you have discounts. We look into that a bit later on. Not much emphasis on it at the moment. And accounting for credit purchases is going to be stark opposite of it. If you look at that here, we enter those in our purchases daybook, and when we record that into our double entry, we have credit into the payables account, which is your PLCA, and debit into both purchases and VAT account. So in this scenario, as we discussed earlier, this one will be the opposite. The payable account will become a liability for us because they owe money. We owe money to our suppliers. So therefore, we expect the money to be paid out from the business. So elements of payroll. So before that, we'll have a quick look into a question where we're going to be learning but how to calculate VAT. So here in this scenario, what we have now, a question. AB sells goods that are standard rate at 20%. How much VAT will be charged on the following transactions? It may seem a very simple question. Trust me, this is where people get a bit overconfident. And they think they remember, they know everything, and then suddenly they start making elementary mistakes. So normally, if you remember how the calculations work, we usually say net, VAT, and total. So here, this net is 100%, VAT is 20%, and the total is going to be 120%. This is how I approach this. You have to think from a perspective when they give you the total figures. If they want you to find the VAT of it, do not try to find the 20% of the total, because that will give you the 24%, not the 20%. Why? For us, the net value is the elementary 100%. The total 120% is just after the VAT was added on. So let's look at the first question. So if I'm going to look at the first one, A, how much we have there? We have sale of goods, £2,000 before VAT. So that means that is the net amount. So that is 2,000. I have got that there. How I'm going to find the VAT? We can do it three different ways. People do anything which makes your life easier. Choose one of those methods. It's absolutely fine. You're going to do it. I would normally say, if I'm going to calculate it, that amount times 20% your calculator. If you do that, what it does, it just works out your VAT. And I also have another method. I'm going to say this one equal to times 20 divide by 100, which gives you the same answer again. You also can do times by 0.2%. That is also give you the same answer. But I have my favorite method. Emma is going to be vouching for me on this one. I call that the pizza method. On the pizza method, think about it. We're going to think about these three elements of it as 5, 1, 6. Why? Because if I'm going to see that here, in this scenario, these is the simplified number if I'm going to divide all of them by 20. So it's going to be 5, 1, and 6. So if I'm going to draw quickly, let me see whether I can draw here. I'm not sure I'm allowed to draw here. Oh, here, I have a draw. Okay, so if I'm going to draw quickly, so if I'm going to say this is a pizza, if you split them into 6 equal slices, one slice, this slice here, this will be your VAT. And these 5 slices, that will be your net. And think about the whole pizza, it's your gross. It only works if the numbers up to 2 decimal places. If it's not 2 decimal places, your answers will not work. Okay, so just be careful with that bit, because I only tell that if that works with the rounding. So if your VAT is rounded down, because that's the general rule you learned about VAT on level 2, it will not work. So it's another way of to think about it, how you alternatively find the answer. So we can do that as well. So if you know that is your 6, oops, very, yeah. So you divide this number by 5, you get the same answer. Can you see here? This divide by 5, you get that number. How to find the total? All you need to do times this one by 6. If there is no decimals, this will absolutely work. Okay. And then now let's look at the B. Now it says here, the sale of good is £456 78 pence. So 45678, 456.78. No, I don't need a 3 there. Butterfingers, there you go. And then how I'm going to find the VAT for this one? You're going to divide this number, oops, sorry, equal to, divide this number by 5. And can you see here, there is a decimal in question. Can you see that decimal? Now, what we need to do, we need to round it down. So we use the Excel. So here, I'm going to use the round down option. So I'm going to say here, round down option. That number, divide by 5. And we're going to do that to 2 decimals. Press OK. Yeah. £31, so £91 and 35 pence. Okay, so we're going to divide that number by 5 and we get that figure. Now in this scenario, we cannot multiply. If I multiply that by 6, I'm going to have a kind of an awkward number because we lost or gained some numbers there. So can you see here? If you add those two together, it won't tally up. So what we do in this scenario, we simply this plus that figure, and we have the total amount we're going to be charging the customer. Okay, the VAT has to be rounded down. So if it's rounded down, the amount we're going to have is £548 and 13 pence. Okay, so that's the question B. Now let's look at question C. So here what we have, the total sales of good is £4,800 inclusive of VAT. So 4,800. And how I'm going to find this one? We can do two different ways as well. Remember, I've said that you can divide it by 6. No, no. We have to say this, that number divide by 6, which is going to be £800. And this one is going to be equal to that times 5. And that gives you the answer. And then the last one before VAT is going to be £1,000. The VAT is, of course, this divide by 5, 200 there, and this is going to be equal to that times 6, 1,200. So it's different way you're going to do this question. Different approach you can do. Make sure if you have a calculator, the calculator allows you to change the decimal. Some of the calculator which automatically do it for you. If you have a scientific calculator, you can pre-program it, but only for VAT. So just be careful there. If you have all pre-programmed, take away the pre-program function of it. So you'll be able to have the right number there and you can make your decisions from there. Now, let's look at the next aspect of it. Well, that is now already done. Let's share the other file. Share. Window. Then we have the where are we? Where are we? Teams. Yeah, PowerPoint slides. So here we've done the VAT. We're going to quickly look into what we know about payrolls. So if you guys think about the payroll, this is not the actual payroll you do in the payroll department. This is the accounting entries attribute towards the payroll department, payroll. So that means when we have the numbers, if you have to account for it, we get this information from the payroll department and we have to put into our double entry accounts. So the elements involved there are gross pay, income tax, anything from the employer and employee national insurance contributions. And then also you're going to have pension contribution from both entities, employer and employee. And if you have any other deductions such as union membership, student loan repayments, you may have charitable contributions, salary sacrifice, so many things there. But we just want to know what are the general terms regarding them. So here, let's quickly look at it. What are the payroll calculation we're going to do? They'll ask you sometime. There are 3 different elements to payroll calculation, which will be examined here. How you be able to calculate net pay, what you take home. Calculating what is the total payroll expenses for the business. That means how much it costs to employ you. And calculating the liability due to various parties such as HMRC and pension. So if I'm going to look at that in further, this is in a nutshell what it is. What we do at the beginning of it, we need to find out what is the total expense to the business. So if I'm going to employ you, I pay you £30,000 salary. That salary is not the expense for the business to employ you. Why? They also have a contribution from their side. That's what they're all complaining about now as well, because the government hiked it up. They have hiked up the employer's contribution towards NIC. And then pension, of course, you have no choice over, because as per the law, all employees must be enrolled into a pension scheme when you start employment with the business. And then, of course, you have the option as the employee to opt out of it. That means if you don't pay, they won't do anything about it. You can just say, no, I don't want it. I want to keep the money for myself now. I'm going to live the day, spend the money at the weekend, and yeah, I don't care about what's in the future. That way, employers don't have to contribute. But if you contribute from your salary, employers must at least match them or exceed them up to a certain level. There is a percentage they go up to. Okay. So here in this scenario, the total expense will be in that case what we paying you as a salary plus both employers contribution on national insurance plus the pension, and then we look at how much employee get paid. So do you think you take whole of your salary home with you? If I pay you 30K, employees take what, 2,500 pounds a month home? No, really, do you? Because you're going to pay something from your side of it. For example, you pay national insurance, you pay income tax, and then you also pay pension, and then other contribution from your salary. They all get taken away from your gross wage, and then whatever left over is what you take home. Probably the peanuts. Everything else is gone. All the parties have put their hands in there, take their share, and you take the rest home with you. And then, of course, once you calculated that paid, and that will be from the bank account, we're going to pay that out. And then, of course, you're going to use these accounts to account for your liabilities. But what you see there is one account in common, the good old wages control account. What is the wages control account's purpose? Wages control account here, it allows you to disperse your wages expense to the relevant entities. That means wages control account simply there to divert all your payments to the right entities. And once you've done them all, it should cease to exist. Gone. They disappear in thin air once all the payments are made. All the money is being allocated to the right entities. Wages and control account will have zero balance after that. It's done the job. Can you remember we used to have an account such a style in level 2? When you done the bookkeeping control unit, you heard about something called suspense. The suspense account it is, isn't it? Remember, the suspense accounts created to find the discrepancies on your double entry accounts. And once you find your discrepancies, what happened to the suspense account will be cleared. Zero balance. Your trial balance matching, suspense is gone. Same as here, the wages expense is going to be something, wages control account is something there to distribute all the relevant entities, and then it's gone now. Let's see, we can do a quick questions with that one. Couple of them, in fact. Okay, so let's have a quick look. Let's stop sharing again. Windows, Excel. Now, let's look at the quick wages expense here. So they're asking you this question. Tower pays its employees monthly. A summary of payroll transaction is shown below. Wages are £60,000. Pension contributions is £2,000. Employers NI £6,000. Income tax is £15,000. That's a lot of money there. Employers NI, it's going to be £7,000. Can you notice in this question, in this scenario, if I'm going to quickly highlight it for you here, they have said pension contribution. In that case, that pension contribution they mean by this is, this one is going to be simply your one, employees. So I'm going to say E. I'm trying to do with this mouse. It's so not ideal at all. I need to get a stylus. Yeah, this is the employee pension contribution. There is nothing from the employer. So therefore, please do not quote me on it. It is most likely to be illegal. If you're just paying pension and the employers are not paying pension, that is not how it should be. But it's for the purpose of questioning. This is your contribution. Employers won't contribute unless you contribute. Okay, so this is what you're contributing now. So they're asking you here, record what is your wages expense. So what I need to do, I need to decide what accounts I'm going to be using here. So can you remember what we said earlier? One of them is wages expense. And then second one is wages control. The wages control account is created to identify what is your total wages expense and then clear the wages expense by distributing that amount to all relevant parties. So what is my expense of employing you? I have my gross wages here. Do I have anything else? Yes. Can you see here the employer's NI? That's £7,000. So the total wages expense is going to be £67,000, and so as your wages control account. So here we'll have a debit entry, and here we have a credit entry. Why that is a debit? Can you see here? Wages expenses. Expenses is the debit account. Okay. So here I need to make sure I have identified that as a debit account. Now, next one. We have to find out what is the total HM revenue and customs liability. So here I need to say HMRC liability, but how much is that for? Which of these amounts goes to HMRC? So if I'm going to look at it here, all my national insurance and income tax both goes to HMRC. NI and tax will go to HMRC. So how much is that altogether here? 13,000 and 15,000 is 28,000 pounds. 28,000 pounds. Is that going to be a debit or a credit? Think about it. The word itself, it says liability. It's a debt giveaway. So it's a liability, therefore it's a credit account. So what is the debit account? Anyone can think about it? Yes, of course. We talked about it. We have that wages control account. So wages control for the same amount will be a debit entry. But again, guys, some of you may ask me why I am done this credit first, debit after that. In the exam, AAT hasn't got a preference for debits or credits. They're both equal. They're both equal to each other. They're on the opposite sides of each other. Doesn't mean debit has to come first than credit, because we use that alphabetically. Credit is first. So I can't have no disparity between them, can I? So it can be either way. AAT accepts answers on their exam. They can put credits first, debit first, mixture of them. Absolutely fine. There is no disparity between them. You can do it, but you cannot put a credit account into debit, which is fundamentally wrong there. So be careful with that. Now, third one is the account name. We're talking about the net wages paid to employees. So do you have an account called net wages? Okay, let's say net wages. Yes, it can be, but it's been paid already. If it's paid already, where the money is gone from? It's gone from the bank account. Yes, absolutely. So the bank account where we have our money going out. So therefore, this is definitely a credit entry. Why? It is a money out. Money in is going to be a debit in the bank. We all learned about it in level 2. In fact, I even taught them in level 1 today, earlier. Yeah. So here, money out from the bank account is credit, but how much? That is the year-old question. A lot of information there I need to process. How much I take home? So we have to take away anything we find which is from the employee contribution. So we have the pension, an employee's national insurance, which is 6,000, and the employee's income tax as 15,000 pounds. How much is that all together? That is going to be 23,000 pounds. But how much was my gross wages? 60,000 pounds. So once those deductions been taken place, 23,000 pounds worth, how much is my net wages is going to be? The net wages is going to be 37,000 pounds. This is the amount I'm going to pay out to my employees. But what is the second account again? Can I create a account magically? No, we're going to go back to using the wages control account. And that is for the same amount. And this time it's going to be a debit. We've done that all now. That's what we have left afterwards. We have the pension liability. So what is the pension liabilities? Pension liability. We collect it from my employees, pay on your behalf to the pension provider. Like if you know any pension provider, we have teachers pension union. So we pay there and it goes there, for the perpetuity. Whenever we retire, we enjoy that, whatever it is. Here, the amount is only 2,000 pounds there. Again, it is a liability. It's in its own word there. And the last one is wages control, £2,000, debit 5,000. Now here, what do you notice here? This wages control account has a credit entry, and these three wages control accounts have debit entries. So here, let me put them here. Now, can you see the credits are equal to your debits? If you add all of them here, 30,000 and 67,000. Can you see here? The balance of the wages control account will be zero. Zero, nil, point, nothing else. Okay, I have a similar question here for wages. It has the same kind of information there. If you want, you can take a screenshot of this, take a photo of it. If you want to try this, please do try this at home. Okay, it is a similar type of question. You should be able to see that later. Okay, so this is how I done it. And then, of course, you probably can take a photo of it or screenshot of it, unless you've done this question type already. Yeah, just keep in mind it's a practice opportunity for you. Okay, it's a similar type of question. Now let's move on to the next section. Okay, I'm just okay with you guys moving on here. Let me quickly share the other file, which is that one. Next one, we're going to quickly talk about what we call capital and revenue expenditure. What is a capital and what is a revenue? Capital is something happens seldom. That means it does not happen often. It happens once in a while. But the revenue transactions are something you do day to day. So when a business do a particular transaction, we need to classify, identify, and find a way to decide whether it's going to be a capital or revenue transaction. It has its repercussions as well. If you misidentify one of it, probably it will reflect on your financial statements. So if I'm going to say I put fuel in my car and I put that as a capital transaction, what happens? Your car value goes up. In reality, it should not. It should come down. Therefore, fuel for your car is a revenue expenditure. I have done an extension to my property. What happened there? I have spent somewhere that improves my property. So what is that going to do? Am I going to do it every day? No, I'll do that once in a while. That is supposed to be a capital transaction. Why? It increases the value of the property. But if I paint my property, I know you do only once in a while. Painting is maintenance. Therefore, it classed as a revenue expenditure. So they have to be identified how the business consider whether this transaction is capital or revenue. Okay, so if something increases the value of the property, we consider that as a capital. If something is not, we will go as a revenue. So here we have some options here. We'll think about it, how to identify them. What is the revenue transaction and how to identify capital transaction? Give me 1 second, please. Let me close my window. So here we look into the financing method, how I'm going to finance a capital expenditure, how you account acquisitions of non-current assets, because non-current assets are the one we talked about it. And we also going to consider what type of non-current assets are there. And then also something called NCAR, which is the non-current register, asset register, where we have record of all of my non-current assets we own currently. Okay, they will have all of my assets listed there. So when I buy a new asset, we add a new entry there. When we have disposed of an asset, means I sold it off or scrapped it, throw it away. We have to make sure non-current asset register get updated with that information. So therefore, people can tally at the end of the year, like you take stock of your inventory, you will be able to take a stock of your non-current assets as well, because you may have so many. If you don't have a record of it, who knows what we have and what we don't have. So it is very important. A non-current asset register is used for this purpose. So how we use, what options we have for financing acquisition. So here we can acquire non-current assets using either cash, means we pay cash. Okay, here we go. Use my bank account balance transfer. If you can do what is that we call again, a banker's draft, faster payment. And then also know if it's a big amount, you do what we call a CHAPS payment. Like that way, we can pay for an asset. We can also part exchange. That means give one of my assets and buy a new asset. That means the amount for a part exchange will be reduced and we only pay the remaining amount. You can borrow borrow loans and then pay for it. You can have a hire purchase. That means you can pay for it until you pay everything off and you own it. And then of course you can do a leasing. And then also you may have an option. When it comes to hire purchase, you own the asset, but they can get it back from you if you don't pay your money. Same like a mortgage. Yeah. Leasing, on the other hand, you don't own it. At the end of the lease, you have option to buy that asset or not. Okay. They're the difference. So here, what is a non-current asset register? An organization records the details of its property, plant, equipment in a non-current asset register. This is an internal control purpose. It is not part of the double entry system. That means it's only my stock sheet. I have a stock sheet and I have an internal control sheet to find out what we have in our non-current asset register. And then of course, when you're going to buy a non-current asset, when you acquire that for the acquisition, we have to have this particular entry. The double entry for purchasing on non-current assets is non-current asset is debit, VAT going to be debit, and the payables or the bank account will be a credit because money going out or we owe our supplier. Also remember the VAT is only reclaimable for certain non-current assets. There is one particular non-current asset I cannot claim the VAT back, which is a motor car. For a car, I can't claim the VAT back. Okay, even if it's for business purposes, we cannot identify whether we have to have some personal usage there, we cannot claim it back. But unless if it's a taxi, if it's a taxi car like a black cab, yes, I can claim the VAT back on it. You won't use the taxi for taxi purposes. Okay. Or an ambulance, those kind of things. They're ambulance cars. If they're purely used for the ambulance, yes, of course, you have opportunity to claim the VAT back on them. So let's see here a capital transaction quickly. So let me quickly change my perspective to this question. Share window Excel. So capital expenditure. Can you see here? Given below is an extract from an invoice for purchase of a new car. Purchase of a new car. Yeah. Write up the ledger account to reflect this purchase. So we have list price of £16,400. We have road fund license of £155, petrol for £40. The insurance is £200. The total amount we have here is 16,795. The VAT on the cost of car is 3280 because it is going to be on that amount we're going to work out. Can you see here? If I'm going to say 16,400 times 20%, that is the VAT. Can you see 3280? They didn't put the VAT on any of it because they're not meant to have VAT there apart from fuel. Yeah, that's a different story. They're asking you to write up the ledger account to reflect on this purchase. So for me now, the car I have acquired has a list price plus VAT. But remember I told you about one exemption of VAT. I can claim back VAT on everything else apart from a motor car. Therefore, when I'm going to capitalize this transaction, the VAT gets absorbed into the cost of my vehicle. That means I cannot claim it back. I put that together as part of my assets. So if I'm going to say here, I'm going to say motor car account. The amount I'm going to have is the, sorry, 1 second, debit, credit. So here, the motor car will be the equal of 16,400 plus how much we have there, 3280. The total cost of that It's going to be 19,680 pounds. Then we also have to expect this road fund license. Do you know anyone what is that meaning of it? Road fund license? It's your road tax. Yeah. So your road tax is 155 pounds. That is an expense. Please accept my apologies. I have my cricket club calling me. I'm not answering today because I had enough playing yesterday. It was so cold out in the ground there. I'm not going out for the rest of the week. I just want to be at home now. I need to be in my warmer climate at my own house. Yesterday I was outside for nearly 8 hours. So yeah, it's not helping me today. The third one is petrol. So we're going to have a fuel account, 40 pounds. And then insurance. 200 pounds. Can you notice I have not included these three into the value of the motor car? Why? These things are yearly cost or running cost. These things are not capitalized. These does not increase the value of my car. These are something I have to incur to operate this motor car. Therefore, these go as expense. This is an asset and these three are expenses. How did we pay for all of them? So I'm going to say here sum all of it with that amount. The total amount cost me is that amount is by bank. Can you notice that here? Bank, 20,075 pounds is the credit. So these are the ledger accounts for that one. I hope that made sense for you guys. It's the important part here to decide which one can be capitalized and which one cannot. So I'm going to give you another example. I bought a machinery which cost me, for example, I'm going to do that here. I bought a machinery, not the machinery, machinery. Yeah, that's better. So machinery cost me the list price of 10,000 pounds. Okay. So you also have paid for installation. Installation. I don't know. Is that the right installation? Installation. Yeah, that's it. Installation. Yeah. I pay installation 500 pounds. Okay. Then also consumables. Consumables. 100 pounds. Subtotal net is 10,600. And then also I have VAT equal to that divided by 5. And then total equal to how much? So this is the scenario here. Now the companies have a policy. They can capitalize a certain expense if that exceeds the certain amount. So in this scenario, the consumable is something I may run out within a month and I have to keep buying them again. Therefore, that cannot be capitalized. It does not increase the value. But on the other hand, installation itself, even though it is sometimes maybe smaller amount, without that installation, the machinery will not be operating. Therefore, this could be classed as something I can capitalize. So in this scenario, if I have to do an entry here, account, debits, and credits. Here, if I'm going to capitalize the value of the machinery, I have to consider this amount here, 1,000 and 1,500. So these two will be the cost of machinery. Can you remember? I can claim the VAT back. So this is going to be going on a different account. Now look at the consumables. That is going to be the consumables account or office expense account, consumables. Okay, so that is going to be 100 pounds. VAT is something I'm going to claim all of it back, 2120. 2120. And then, of course, what we paying by bank is going to be adding all of those together. It's going to be 22,720 pounds. 12,720 pounds. This is how we're going to be entering it. Because in this scenario, the installation get capitalized with the cost of your assets there. So it's very important. You have to identify with the language they used in your question. I will find some questions later on, probably on the next session. I'll be able to add something there so we can do as a quick starter activity. Now, we've done this now. We're going to move on to the last bit, which is our depreciation. We're going to talk a little bit about depreciation, and then we'll do a couple of questions, and then we'll go from there. Okay, so let's see. Stop, share slides. Yeah. So anyone knows what is the depreciation is? Why that is important? Because when you buy a non-current asset, that non-current asset, we can't hold it in perpetual. I cannot hold it for the eternity. Why? Because they have a shelf life. If I have a car, if I keep it for 5 years, it serves the purpose. We probably get good mileage out of it, and then we dispose of it. That means we give it back to the trader and get a newer car, because you don't want to have a car which might be unreliable going forward for the business purpose. For a normal, like a person, a citizen of the country, for that person, a second-hand car is fine. For a business, you rather have something reliable which serves for the business well. So what do? You only keep it for a certain time period. And in that way, that value of the car depreciates through the time. And that depreciation needs to be acknowledged and declared in our accounts in an annual basis. Therefore, depreciation itself, one of the very critical things in the life of the organization and the accountants who deal with them. So for the purpose of it, let's see here, what is the purpose of the depreciation, how we account for it, how we put the depreciation in the non-current asset register, and then how you calculated the depreciation. We have straight line and diminishing balance methods. We're going to look into those things in more details on the next week's sessions. We're going to look at that, and then the disposal of non-current assets in more detail. Okay, we will be doing it much more in depth, because today's session is only a taster session there. So probably we'll do a couple of more slides there and do one question, and then we'll call it our day. Okay, so let's see here. What are the things to consider? What is the purpose of it? It says the allocation of the depreciable amount on an asset for over its useful life, the measurement of cost of the non-current asset consumed in the period. So that means if I buy a car for 20,000 pounds, I expect I use at least 30% of that value on the first year. So that means 6,000 pounds worth of value of that car is used on that first year. That way, when I'm going to consider at the end of the year, the value of the car now is 14,000 pounds, even though in the book it says 20,000, but the realistic value of that one, we call it, is your carrying value. After the depreciation is calculated, we'll find what is the carrying value of that. So the facts to consider is how much is the cost, what is the useful value life, and then also residual value, how much I can sell it for. And the end of the useful period, like probably sell it for 5,000 pounds. I have to consider that residual value as well. So let's see here. What are the other concepts involved in there? So here, how we account for it on the depreciation, the double entry for that one, the expense account of depreciation charge will be a debit, which goes on the statement of profit and loss, and something called the accumulated depreciation, which will go on the statement of financial position as a liability against the asset I hold. That means if I have an asset, that asset has the book value, and the accumulated depreciation will go against that asset as a liability, which will give you the net value of that asset. That is called the carrying amount. Carrying value, carrying amount, or such a way you can think about it. It says CA, CB, it depends on how you classify them. Okay, so that is what is for depreciation. So quickly look at into one of the questions. Let's see whether we can identify one transaction where we can learn how we're going to be doing a calculation for depreciation. So let's look at the first question here. That's it. We only do that question. I'll be done for the day. So a non-current asset register was purchased by Bob. Bob. I don't know how to pronounce it. If you probably see there's a video of Rowan Atkinson trying to pronounce Bob. That was the classic comedy you're probably going to hear from himself, like famous voice Mr. Bean, Johnny English character. Yeah, people who doesn't know um Rowan Atkinson, that means you missed that out in your childhood, because he made a lot of what do you call a light-hearted moment for me when I was young. I was sincerely the biggest fan of him when I was during my childhood. So there we go, Bob. On 1st of January 2021, he bought something for 48,000 pounds. It has an estimated useful economic life of 6 years, an estimated residual value of 8,500 pounds. So what we have to consider now, what will be the depreciation charge we will do at the end of the third year? It's a very big question, but we can cover a lot of things here. So what would be the depreciation charge for this asset, the ending on 31st of December in 2023? So please remember, that is the third year of this assets being used. So let's consider what are the facts. First is the cost. What is the cost now? It is 48,000 pounds. What is my residual value? Means what is the money I'm going to get when I'm going to sell it? Is 8,500 pounds. So what we will call here depreciable amount, because this is what we need to do. We need to identify to see how much I can depreciate it, because it says here we use it for 6 whole year. So that means I have to depreciate equally for 6 years using straight line depreciation method. Means every year we charge the same amount of depreciation. Okay, but it has to be equal. So for that one, the depreciable amount is that minus that. We're going to say useful life is 6 years. Therefore, annual charge is going to be equal to that amount divided by that, which is going to be 6,593 and 33 pence. So let me do for 3 decimals. Okay, so this is the charge I'll be charging every year on this one. So that means at the first year end of it, so if I have, this is my non-current asset register, sorry, non-current assets in my statement of financial position, current assets. So we have NCA. This is we call cost, accumulated depreciation, and then carrying amount. So if I'm going to do this way, the asset will be recorded in such a way. Cost is going to be that amount. Accumulated depreciation is going to be that amount on the first year. The carrying amount will show in the book as this minus that. That's on the first year. The next year, this get more and more and more added to this one. By end of 3 years, we have more depreciation attached to this. But please remember, guys, this accumulated depreciation increases. What will happen to my carrying value? It keep on reducing. Okay, so that is the point you have to remember there. But this is what we call straight line depreciation. So in this scenario, every year I'll be charging this amount. By the time I reach the end of 6 years, that means the end of 2026, means next year end, December 31st, my asset will have depreciated all of this 39,500, because 6 years I've depreciated them. So what is the left? Is this residual value, because we will be scrapping it, selling that for 8,500. That is what expected. We may not get the same amount. 99.999 times, there's a chance it may get different. Okay. Then now let's look at the next method, diminishing method. So this one carried out in a different way. So when you do the straight line, we need to find a depreciable amount. When it comes to diminishing based, we don't can consider this residual value here. This residual value is not a factor. It only works out on the non-current asset registered carrying value. So if I'm going to do that here, I'm going to do the same way, but we're going to do in this scenario, in the non-current assets in my statement of financial position. So this one uses the diminishing balance. Okay, so this is going to be diminishing balance depreciation, DPR. Okay, so here the first time is cost is 48,000 pounds. How much depreciation I can charge on year one? So let's say here year one. Year one will be this amount times 25%. So it's going to be 12,000 pounds. So here I'm going to say that is going to be 12,000 pounds equal to that amount. So what is my carrying amount will be? This minus that amount, which is 36,000 pounds. That's the year end first. Now let's look at this. This is my year one. Why? Now year two, which is end of 2022, what was the depreciation charges? What is my NCA? It's still the same. It's still the same, but the depreciation I'm going to charge on the second year is going to be year two. It is going to be on this amount, the carrying amount, because it depreciates less, because on the first years you charge more depreciation, and on the following years your depreciation comes down. So the year we're going to be charging, this is going to be that times 25%. Look at that now. My depreciation is only 9,000 pounds for the second year. So what is my total depreciation? So far, these two figures is my depreciation. So I'm going to add these two together and have 21,000 pounds. So what is going to be my carrying amount? Look at the carrying amount now. It has reduced by that minus that. Oh, hold on. Can't be that minus that. Yeah, 27,000 pounds. That is the end of year two. So now let's look at the year three now. They want you to find out how much is the depreciation charge. Year three, what is the depreciation charge is equal to that amount, carrying amount, times 25%, 6,750 pounds. So on my NCA, I have that, and then I have the sum of all of this. And yeah, I'll put this one down here, 20,250 pounds, which is my carrying amount. But they didn't ask you that question, did they? The question they asked you was, what was the depreciation charge at the end of the year? They didn't want you to ask any of it. They want you to know this figure. So that is the answer for B, and this is the answer for A. Can you see the difference now? This will be charged for 6 years continuously, but the depreciation, when you use the diminishing balance method, this will come down. Can you see here? It comes down further. Let's see if I want to do a year 4. What will be my depreciation charge? Can you see here? This amount times 25%, which is going to be 5,062.50. And so and so and so, you start losing the value going down the line. Okay, this is how the depreciation calculations work. One of them is straight line, where you have equal amounts throughout the useful life of the the non-current asset. But when you do the diminishing balance, you just go from the original value and then the carrying amount in further years, because it diminishing. Can you see here? The balance is diminishing, so as your carrying amount is diminishing. But the book value of your asset, £48,000, has not changed. I have few other questions I wanted to try, but at the moment, it's going to take a long time there. But I will discuss this next week with not next week, sorry, next session in few weeks' time. Please keep an eye out for Emma. She's going to be putting this up, notification on your Facebook group, and it's exclusively for this group only. So people from this group only, you